Hey everyone, you're listening to the Active Turnkey podcast, a podcast designed for hands-off, passive real estate rental investors. In the Active Turnkey podcast, you'll hear Tom Olson and Jared Stoutmeister discuss all things turnkey rentals with other turnkey providers, service providers, and rental investors. Our goal is to help you reach your financial freedom and whatever comes after that. Let's go. Welcome back to the Active Turnkey podcast. I'm your host, Jared Stoutmeister, and this is again the Tom Olson, and we are here for another podcast. And today we are talking about how to analyze the proforma.
How to analyze a proforma. That's an interesting topic, Jared.
It is interesting. I usually say interesting, and you usually tease me about it. So you actually said it was interesting.
Very interesting.
Now, there are some people who, they love this stuff.
Oh, yes.
I mean, this is...
So if you're the data geek, if you're the person that really wants to get down to the number crunching, if you love spreadsheets, like this is going to be your podcast, right?
Man, buckle up, guys.
Yep.
It's going to be exciting.
But I think it's important. I mean, the numbers are something that you do need to know when you're looking at a property. And a proforma really is kind of a way to be able to, in a quick glance, on one piece of paper or on a short, piece of paper, see what is likely or what could happen or what should happen or what would be a reasonable prediction of what could happen.
So, okay, you say that. So let's just start the podcast that way. We do plan in this podcast to go through a typical proforma. We're going to choose one we have for a deal that's coming up. We'll walk through some specific things, but for now, just a general question: what is the proforma?
Right. So the proforma is not a guarantee of what's going to happen. I think sometimes people think that that's what a proforma is that this that just because I see a proforma does not mean that I automatically assume that all of those things are going to actually happen. A proforma is what should be likely, from the experience of the provider, because proformas are not just in turnkey rentals. They're in hedge funds. They're in mutual funds. They're in all these different types of investments. There's a proforma. Now, are proformas guaranteed? No. If anybody ever shows you a proforma and tells you that these are the numbers and I guarantee these numbers, I would run for the hills. And I'll give you some examples. There's a couple people that they're no longer in business, and it was very obvious that they were not going to be in business for very long because they were guaranteeing rents and guaranteeing maintenance. All maintenance and all rents were guaranteed for a whole year after and at the end of the day, what ended up happening? The property manager, the provider went out of business, and this was not just happened once. This has happened more times than most people would even like to admit. And it's hundreds and hundreds and hundreds of properties that these providers were providing to people that are now, and then who ends up losing? Everybody. Yeah. It's not just the property manager that loses, but you also lose as the investor. So the thing is if you don't want your provider to make money or your property manager to make money, at the end of the day, they're not going to be in business anymore. And if they're not in business, then who's taking care of your asset? So and I know that your job as an investor isn't to make sure that a property manager makes money. I understand that, totally get it. But at the end of the day, you do want there to be an equal exchange of services for money one way or another, and that's the same way a proforma should be. You should look at a proforma that way. Proforma is not a guarantee. A proforma is in somebody's opinion of what they predict should happen or could happen with a particular property or a product or a company. I mean, you even see future proformas on companies. You see proformas on multifamily deals, and so I think that's now for our proformas obviously going to be different for a single family resident or for a smaller deal than a larger proforma. Larger proforma with 120 units or 360 units is going to look vastly different than what you're going to see here. A lot of times when you're doing a syndication deal or something like that, with a lot of properties all at once, there is no money coming back to you right away. Sometimes you might wait 6 months, a year before you get a penny back in your pocket. So, you might invest $50,000 or $100,000 into a syndication or an apartment deal with a guaranteed maybe, and I say guarantee loosely here, but it's like a 6% preferred, for instance. So there'll be a 6% preferred on your $100,000, but you don't start getting that until year 2. And it's always different. different funds have different ways that they can set their things up. But a lot of funds, what they want to do is they want to start giving you a small preferred return, and then they want to build up enough cash reserves. Cash reserves is a very important thing, and it's not really on a performa.
Sure.
Because it's not really part of the performance of a property. It is the part of the performance of how you're going to do in the long term, of making sure that you have the cash to be able to sustain properties in good times and bad times. But that's probably the missing piece in single family residence that is in multifamily residences. You normally have a nice, comfortable reserve of 3 to 6 months of all expenses if no income comes in, to be able to make sure that they can stomach goods and bads. And a roof for a multifamily, might be $80,000-$100,000.
Sure.
It's a big deal.
Yeah.
And when a roof goes bad, they've got to get taken care of. So a performa is just that. A performa is just an opinion of what somebody thinks might happen.
That's good. And if Tom were to turn back around and say, Jared, what is a performa? If you were to ask me, I think a lot of the information is like you're saying, that you're talking about down the road, but also it's present day too. I mean, that's where the information is the most specific, because it's today's numbers. So, I mean, that's the best you can do, is like, what does the deal look like today? Because the market could go up and down, things can happen, you just don't know. But the best information is to go off what's today, and of course you can look at trends and so on. But
not only that, so I think when you say that, and this doesn't have any really pertain to a performa, but really what I've always heard and what I've always experienced is the best deal is not the deal. It's always the deal after the deal. It's never the deal. It's never like the first year. It's never the first 2 or 3 years into a deal or a relationship or a product or a house. It's always that like next step. It's that 3, 5, 7, 10 years down the road. That's really where all the money's made. And I don't care who's told you what, but if you are going off of this performa and expecting this cash flow to be able to survive, I think that you're a fool. And I'll tell you, don't do that. It's not what this is meant to do. Do I think that you can retire off of rentals? Absolutely. But if you're going to retire based off of what this says, a $257 cash flow after vacancy and after maintenance, $376 a month. Before that, which is what most providers would just show you, only that 376 number cash flow. If you're relying on that number 100% to be able to survive, then just don't do it. I'm just going to warn you. It's not going to always be peachy. However, what this also isn't showing is in 10 years from now, this rent on this particular property, say, I'm trying to see where the rent says. It says it's $850 a month. Well, the rent on this particular property could be $1,250 a month in 10 years.
Sure.
So that it also doesn't necessarily show that. Now, ours has a little bit more. We do have a little bit more projection out 10 years. And some of that is thinking, some of this is some rent increase, some of this might be tax increase, some of this might be other increases as well, but so do the other costs go up. So the appreciation, the vacancy is going to go up, the income is going to go up, closing costs, but maintenance, also stays constant. It's going to be based off of a larger number over the long haul. So anyways, so just before we get going, like I said, this is not, showing this performa is not like, giving you investment advice. Go talk to your investment advisors. We are just giving you our opinion on what a performa is and what, how to understand a performa better.
Absolutely. And then I guess the next thing would be to say is you need to verify the information that you do have that's concrete. So, whatever that line item is, does need to be verified. And if you were to ask any kind of provider that's sending you these performas, they should be able to answer that question. Why is the rent this? Why is the cap this? Why is this? You can ask that question and they should be able to help you with that. And we'll get more into those details as we move along. So Tom, as we look at the performa, if you see one of these things and someone slides you performa and says, hey, check out this deal.
Yes.
What do you look at first?
I'm the weird guy, so I am the nerdy guy. So the first thing I'm going to ask for is something that's not even on the performa.
Here we go. What's your plan? Is that what it is?
No. So I mean, really, so I want to know more details about the property, really, and I want to know more details about, we're other podcasts where we talk about property management. We talk about, so to me, that's the stuff I want to know first. Who's backing this? Who's going to make sure that that the house just doesn't sit vacant for 8 months.
Sure.
You know, I've heard horror stories that, you know, property managers are in properties and like it literally just sat vacant for 6 months and nothing happened. And I'm like, what in the, like, I don't understand. I don't understand that. But so I want to know that. And then I want to know about the house and I want to know about the area. And, you know, so for me, the first thing I would ask is about that. And for this, like, we are very transparent about this. These are C areas. Like, so this particular property that we're going to hear is not your B class, not going to be, you know, $150,000 house. It's not that, well, it could be D class and F class in some neighborhoods, $150,000. But in our market, this is a C class neighborhood. So this is a neighborhood I probably wouldn't live in. This is a neighborhood that I probably would let my wife go to, but she probably wouldn't be there at night.
No.
And you know what I mean? But I'm being completely transparent. And those are the things I'm wanting to know first.
Yep.
And if I'm okay investing in those neighborhoods, which obviously I am, because we have a lot of properties in these type of neighborhoods, you know, I want to know the other factors. And I think the other factors, we do kind of try to give the best we can just from our experience in the market and just with our experience in these things. So the appreciation. I think right now, personally, I think the C-class neighborhoods is where all the appreciation is left in the next 5 to 10 years. And I actually really honestly believe that if we have a recession, these C-class neighborhoods might even continue to still go up in value. I can't guarantee that. It's just what I feel. I feel like if they're way underpriced, I can never build this property for this much for this much at this point, and at some point that's going to catch up to you. Some point it has to get back to that line.
So you're telling me you cannot build a brick home for $62,500?
No,
okay,
you can't. Right. I don't see it.
I was just.
I don't even know that you could build a unit if it was a fourplex.
What if I told you I could build you a home for?
Then I would have you build 200 of them.
Okay, fair enough. I got you. Okay. So now that's really good. So you're walking through. He wants to know all the information. That's really good. Is there anything that jumps out to you though? Is like so everyone has kind of like their thing. You know, some people it might be cash flow. Some people it's cap rate or well whatever that is. What is your magic number on the Proforma itself?
Boy, that's a great question. I think they're all magic numbers. I don't have like the one magic bullet that I'm like, this is what. I mean, for us, we have like several things that has to fit when we're doing a deal, and you need to figure out what that is for you. Absolutely. And this is kind of partly where you can figure out what those numbers are for you. So for us, like I don't want to do a deal unless not including. Cash flow, I mean, not including vacancy and maintenance, I want to make $300 a month. So including that, maybe it's only $200 a month. Maybe that's my number. But I'm really looking at about $300 a month that includes all my expenses minus those two expenses. Right. So again, a lot of people might only make $150 a month on that, whatever. But $200 a month, $250 a month, that's really what, I mean, those are one of the key numbers that I'm looking for. I also want to know, I mean, all these numbers are very important. So like how much the rent is. I mean, I think on this particular property, for instance, says the rent's $850 a month. So a $62,000 property for $850 a month. To me, those are already like I can already start to say these are pretty good numbers. Sure. I mean, that's kind of like, I mean, if this property were to rent for $650, it'd be a good deal to some people. Yeah. But for me, those are I'm looking at those two, and then I'm comparing that to what I already found out about the property. What kind of neighborhood is it in? What are the other risks associated with this property? So to me, if I'm getting $850 a month for a $62,000 property and it's in a C neighborhood, I'm okay with that. Right. Now, if it was in a B neighborhood, I would be way better than that. I don't think you're going to find very many B neighborhoods. I don't think so. That are these types of numbers, but. You know, but on the flip side, maybe if it's a $115,000 property, $120,000, $130,000 property, and it's renting for $1,350, okay, I might be okay with those. So maybe it's the hope, maybe the cap rate on here looks a little lower, maybe the cash on cash return looks a little lower, but for me, it's a little bit less risky because it's a little bit better neighborhood and it's a. You know, it should be more stable, although we found it's about the same. Yes. As far as people in, people out. People wrecking the place, people not wrecking the place. We, again, in our area, in our experience for the last 20 years that I've owned rental properties and the last 7 or 8 years that we have been doing turnkey rental properties for people, that's what I have found. There's not much difference in today's market in this C-class neighborhood. Now, there was 5 years ago. Sure. So that's the other thing you have to know is the market. But that's not in the performance. So I think it's very important. The all-in price, well, that's how much you're going to pay.
Sure.
Right? And then the very next line item there is what we put. Now, some people just pay all cash. So if you were to pay all cash, then some of these numbers wouldn't apply to you.
Oh, yeah.
But if you paid all cash, it'd be $62,500. You wouldn't have a down payment. You wouldn't have the first mortgage. You wouldn't have a mortgage payment, and your cash on cash return. I mean, your monthly cash flow would be much larger, right? Now your cap rate would be a lot lower.
Sure. Yeah.
So your cap rate on this may only be 8.5%, 9%.
So why? Why would it be lower?
Not your cap rate. Your cash on cash return may be lower.
So why is that?
Because you have $62,000 in the property. So if you have $62,000 in the property and you're making, say, $850 a month minus, it'd be minus $473 minus the mortgage rate, which is $483.89. So you're looking at so it's a $660 a month cash flow with no mortgage. So it's less risky.
Right.
But your cash on cash return on that's going to be way lower. You multiply that by 12, which should be your NOI for the year, which is about $7,922.16. And then you divide that number by how much money you have in the property, which is $62,500, and it comes out to, well, that is kind of the actual cap rate. So it's still, well, I'm sorry, that still comes out with the same cap rate that we have down here. But basically, your cash on cash return is going to go up dramatically.
Sure.
On this one, okay, sorry, your cash on cash return is 24% if you only put 20% down on this property.
Right.
So it's 24% versus 12% if you are all in cash. So it's a great cash deal, I think. But you, again, like if all things go perfect, which they don't always, but sometimes they will go perfect for years. Like you'll have properties where you have nothing. You have a tenant in there for, I mean, I have a property right now, the tenant's been there for 20 years.
Yeah, that's nice.
Now, does that happen very often? No, but 1 out of every 100, you'll get one of those. So, but I can't base my whole portfolio on that one property. And I haven't barely done anything to that property. So, but there wasn't not a whole lot of maintenance costs either. So these maintenance numbers would have been low.
Absolutely.
So I could put a performa based on that property, but that wouldn't be a very good performa to show. No. So so that's kind of the difference between a cash performa. And I think I believe you ought to look at that. You ought to look at it. If I do a deal cash versus if I do a deal financed, is it worth that to me? I really believe that you ought to look at that, because sometimes it's not. Sometimes if you're only going to make like 5 or 6% more leveraged, it may not be worth it. But some people it might be, depending on the numbers and depending on what other options you have out there. I think it's something to consider. So on a typical performa, you're going to have a picture of a house. You're going to have or pictures. You're going to have the address of the property. And those are key things that you can take data points other places and find out other information about them. Normally, you're going to have an all-in price. On ours, we have 20%. We assume a 20% down payment, 80% loan. I also want to look at the mortgage rate. So right now, our performance say 5.5 mortgage rate. Well, actually, most of our rental properties that we've been sending out are lower than that right now. Right now, I think they're in the 4.9, 5.2. That's probably the typical Fannie Mae loan that we're seeing come across our desks right now. So really, that number might be a little too high. So I think knowing what's reality versus, but at the flip side, I've seen people send out 4.2 mortgage rates when they were 5.5.
For sure.
So know what the real truth is. Just because just because somebody says it's 5.5 doesn't mean it's 5.5.
Sure.
It might be 6.5. It might be 4.5.
And it could be different interest rates for different people based upon their certain situation, depending on their financing.
So for us, we're trying to be a little bit more conservative. Absolutely. We try to stay on the higher end of what we're seeing people get rates. We try to get updated from our lenders that we're working with. So that's what we do. Property taxes is kind of jumped down into monthly, so $45.31 on this particular property, which is low. So just know that. That's a good thing.
It's very low.
Insurance, $59.50. Now that would be high for some people and low for other people. I think there's different things with that. I just talked to a guy, his average property is only $480 a year for property taxes, but his properties are maybe really low class, like $40,000 properties in Cleveland. so maybe that's that property management. It's something that you want to have in your performa. This is what the monthly cost is going to be for that $850 rent. And then normally, so for some properties, there is a water softener you have to worry about. You got to pay for, the owner may have to pay for garbage. The owner may have to pay for lawn. So normally you want another line in there to have just if there is other costs. Sure. Now, this particular deal, we don't, the owner doesn't have to provide any of those things. So there's a zero in there. And then the total monthly expenses. So total monthly expenses is just all those numbers that we just talked about added up. It's just math. So it's not a crystal ball. This is just math. So then we have the total monthly expenses. Normally, you're going to want to have an ARV. When you're buying turnkey, you are pretty much going to be buying really close to what that value is. So just so you kind of know, somebody else has done all of the work. Yeah. Somebody else has already made sure that they've gone through the whole process to get the place up and ready to go. And done all that hard labor, and then also they took the risk at the upfront. Absolutely. They found the tenant. They're all they've got this place all up ready to go. So it should be a good performing asset for you for 5-10 years to come. All right. So the next thing is property details. So the property, this is kind of where you kind of get into more stuff. Like, this particular property is a 3-bedroom, 1-bath house. How big the house is important. Yeah. Some people don't like to live in 700 square foot houses. So for us, we are really looking for, even the 3-1s, we want them to be like around 1,000 square feet. Absolutely. You get too small and they don't appraise for as much. They don't, and the people that buy them don't like them as much. I'm not going to get into 3-2s versus 3-1. Obviously, a 3-2 is better than a 3-1. But in this market right now where we're at, these houses are renting, and I'm actually thinking we'll probably get more than this $850 for rent. Absolutely. Again, all the numbers that I think you want a provider or you want a conservative approach to this, and because the unknowns could be bad just as well as the unknowns can be good. Absolutely. So trying to stay as conservative as you can in some of those approaches is great. So the annual property taxes we have on here, again, that kind of number feeds that other number on the top, and then the year built on the property. So that's the other thing that you want to know as well, because now, for our properties, most of the time when we're buying a property that's old, like this property is, we are replacing almost everything that is not really new. So I think, but that is a factor. So the older the house, the more of a chance it could have to have foundation issues down the road. The more of an issue, a potential it could have if the plumbing hasn't been updated. It probably should be. If the electrical hasn't been updated, it probably should be. I believe that both of those have been updated in this property. Yeah. Obviously, to me, the big things in the properties is foundations, is roofs, is HVAC, plumbing, and electrical. If those things are taken care of, everything else is kind of gravy. Sure. We like to put granite in or quartz in or something a lot nicer, because we have found that just that one addition to a property makes it rent much higher, much faster, and gives us a pick of who we rent to. Sure. Versus putting it out there and hopefully one person comes and hopefully you have to accept them. They only have a 450 credit score. We don't want to do that. So I want to be able to pick from the best of the best tenants, even in these C-class neighborhoods.
And actually, as you say, that little bit of a rabbit trail, but you mentioned something that in the C neighborhoods, before it was more difficult finding a tenant in those areas as opposed to the B area. I had an investor come in and actually visited this house that we're using for this Proforma, and he asked me that question: do you guys have an issue in the C class placing tenants as opposed to the B class? And I said, actually, no, they go through the same vetting. And they're vetted the same way. And so you may see the lesser people fall out more than you would in the B class, but they're still vetted the same way. So I just thought that I tossed that thought in.
Yeah, my criteria is still the same.
Absolutely.
I was at a conference last week, and the guy said, I haven't run a credit report on a tenant in 5 years, and I was like, I don't care if they're Section 8 or not. Yikes. I am still running a credit report. I don't, but that's that is rabbit trail off of the performance. So, for us, then I kind of also want to look at this thing in an annualized basis. So that's kind of the next part of our performa. Different people have different ways to do their performa, but our performa has the cash ROI, which is, some people call it the cash on cash return. And this is making the assumptions that we made in the top. So know what the assumptions are on your performance as well. Right. And if you don't understand what those assumptions are, please ask the person that gives you, hey, what assumptions are you using when you're coming up? So cash ROI for us is if they were to only have put $12,000 down.
Correct.
So we are looking at this, if they put $12,500 down, and they have to pay a mortgage payment, well, they're only going to make $3,087 per year. But if you've only invested $12,500 of your money out of your own pocket and you make $3,000, it's a 24.7% return cash on cash. And when you look at it from a cash on cash perspective. So know what that means.
Right.
And I think when it comes to performas, asking the people that are giving the performas back and forth, just kind of having a full understanding of what it is. What does it include? What does not include? What do you want to include? I think everybody should kind of have their own little, if somebody sent me a performa, I'd want to put it back on my performa of how I'm making, and that's totally fine. I think that's great. Maybe your performa doesn't have some of the stuff that we have in it. Maybe has more. That's totally fine. And I think you ought to work that way with everybody that you work with. At the end of the day, it was funny. I was asked this question last week. They were asking about a local wholesaler, and they said, I just want to know your experience with this wholesaler. Have you bought properties from him? And how well are those properties performing now? And would you buy from this wholesaler again? And I was like, number one, like whether or not I buy from this wholesaler or not has nothing to do. This wholesaler has nothing to do with my performance. I am, to me, is like the worst question you could ask me, because how well my property does is 100% on me, not on the person that sold me the property. So I need to own that when I'm buying. And I told the investor, well, first of all, 100% of the responsibility lies on me. Whether or not this property is performing or not has absolutely nothing to do with this wholesaler or not. And I know people, try to, and I think we live in such a negative society that everybody just wants to try to find a way to bash with whoever they possibly can whenever they get the opportunity to. Sure. And for me, it's very frustrating because I try to live a life completely opposite and opposed to that, and to try to uplift people and give people a chance and try to find the people that deserve the chance that haven't been given the chance and try to help those people. But for me, that's about personal ownership and understanding, and that's what this is. This allows you personal ownership. You can look at these and say, hey, well, that's okay. I don't like it. But whether or not you like it or not, it's not their fault. It's not the person that gave you this performance fault. It's up to you to decide, what are you comfortable with, and what's a deal for you. So that's what a performance is really meant to do, is to not necessarily predict the future. It's to help you understand if it's a deal or not. That's it.
Yeah. I presented a similar turnkey deal that was in I would say probably a B-class neighborhood at a local meetup group. And Tom was actually on a panel with several other seasoned investors. And when we got to this section, particularly the cap rate, the guy was challenging me on the cap rate number, but also the cash on cash particularly. And it was because even as a seasoned investor, he did not put the two and two together, that, hey, this is based off of the down payment and not off of cash. So this guy's more of a cash guy. So he was seeing it from a cash perspective, and it was throwing off the numbers. And so looking from that lens, he was like, these numbers are wrong. they're inflated. There's no way your return's that great. But again, it was because of, like Tom said, it's showing from what's above. So if you think that something doesn't seem right, it's best to ask the question. It's also not best to trust somebody either. Ask the question on both sides.
Yeah, so the performa, you ought to have your own performa that you're running, that you say, hey, this is what I think is going to happen. And if you're an all-cash buyer, then yes, absolutely. But that also means that your cash ROI is going to be a lot higher in number. So you might put $62,000 down. You might receive $8,000. You might receive more than twice this cash. Right. But you could have also bought 5 properties for the same amount of money if you would have leveraged them all. So there is a trade-off, and don't get me wrong, I think there's times for debt and there's times to not have debt. So I'm very in the middle on that. You don't have to argue with me that one's better than the other. I can see from both lenses that that both can be good, and I've seen people be successful with both. So again, ours has annualized returns on the cash ROI, which does not include some of the other things that are happening in the deal. So again, we only throw this in here just so people can kind of start to seeing what's else is going on. But and again, we are not an accountant, but there is a tax reduction. So you do get a depreciation on this property, and that tax reduction is based on what we would think a normal accountant would put for depreciation. So that gives you a tax reduction of on this property and that's also based on, again, some assumptions. So you have to know what those assumptions are and what tax rate you're in for those particular items. I believe that we're making all the assumptions on this based on a 25% tax rate. So if it's 25%, if you're in the higher tax rate than that, again, we're trying to be conservative. So if we were to put it at the highest tax rate, 38% or whatever it is now right now with today, it might be a lot higher than that. So but we put a tax reduction at $453. That's a real cash that you don't have to pay in tax that year. Also, principal reduction. So something that going down the line, and this is only in year one. I mean, I believe, it keeps the principal reduction, the way an amortized loan works. Everybody needs to understand amortization. They really do. And that's a data geek thing as well. Yeah. But the way amortization works is in the first year, you barely pay any of the principal off. A $100,000 loan, you may only pay a couple $100, $500 off of that loan. And it's kind of like, it goes like this. It's not like a straight line. It's like this. So you're paying off extra interest on top of interest for a lot longer period of time until you get to about year 15. And that's when you really start paying. You pay like 60, I think it's 65, 67% of the interest off after year 15, 30-year mortgage. So like, just understand how that works. But so this is only making assumptions based off the first years. Wait till you get to year 7, year 10, and this principal reduction amount might be 12, 13%. As far as return on that original $12,000. So just so you know, all these numbers in our annualized number Proforma are based off of the return on the $12,500. So again, and now this sounds crazy. Trust me, I understand that. I get it. But I mean, I have actually gone through and I've shown people how they've actually made this particular property 68%. If you add up all the things that are going on in the property, so the cash, the principal reduction, the tax reduction, and the appreciation. So, I mean, the appreciation is really where all the wealth is built. So understand when you're building a rental portfolio, you have to focus on three things. You have to focus on making sure you have enough active income, which is not the rental portfolio, but it's your other active income to cover stuff. Also, you're the cash flow. So the cash flow is a very important piece of it. But then it's also the wealth build. And that's what I love rentals, because they can give you all three of these to a certain degree. If you have enough, I wouldn't rely on the active income of a rental until you've got a very large portfolio. Right. But, that's where you're building wealth, whether you realize it or not. And the people that don't build the wealth are the people that give up and quit. Absolutely. So if you're in a property like 2 or 3 years and you sell it, like, you shouldn't have probably never done it in the first place. Right. It really, like, I'm just being completely honest with you. If you're not going to invest for the long term, if you're not going to say, hey, I'm going to stick it out and stick through this for the next 10 or 20 years, I wouldn't even recommend. I would just tell you to be a lender. I'd tell you to go invest in funds. I'd tell you to go do something else. Right. But unless there's a play to just cash out in 3 to 5 years, I've seen 3 to 5 years as an exit strategy at some point. But as your houses do appreciate, and they will, over the long haul, they will, unless it's in the middle of Timbuktu, and I think then depending on what state you're in, it still might appreciate. But your money, that's where your money's made. Your money's really made in the appreciation. Your money's made, your wealth, I should say, is built there. You just can't spend that. But that's where the wealth build is at. And I just think it's important to kind of see what else is going on in the property. So you might look at this thing and just say, there's no way. But I have actually seen owners that actually had a 68% return on their investment if you count up everything else that's going on. And if they look, I had one investor that told me he wiped out all of his active income with his 20-something rentals that he had with depreciation for a certain year. I mean, there's many different things that are going on here. So the other thing is financial indicators. So this also gives you the debt coverage ratio, which I think is an important number to track and to understand. The annual gross rent multiplier, and the capitalization rate, cap rate. So a cap rate is basically the easiest way to think about cap rate. And I know this is not the definition of cap rate, but the easiest way to think about cap rate is like, if you were to pay cash, what would that cash on cash return? It should be pretty much the same if you're paying something for cash as what the cap rate is. That's the easiest way in layman terms to be able to tell you what the cap rate is. I know that the appraisers and I know other people have different opinions on how a cap rate is calculated and what it means in the definition, but again, I've been doing this for 20 something years, and I can tell you that the easiest way for me to explain it is the return you would make if you paid cash for that property. And then, so for us, we know that a C-class neighborhood is going to have, right now, we are assuming, we've actually seen probably a 12 to 15% appreciation over the last 2 years. But we have this a little higher. Our B-class neighborhoods, we only have like a 3 to 4% appreciation rate on these things. But we have a 7% appreciation rate on these properties. But we also have vacancy losses as higher.
Right.
So a typical vacancy loss, we're putting that around 4 to 5%. For the C-class neighborhoods, we're putting them at 7%. So these are higher. The income growth, so we're putting a lower income growth rate. So we're only saying 3% increase in rent each year. That number probably is low, and we've seen that to be low. I mean, I'll tell you, the last 3 years, this same property probably used to rent for $675 3 years ago. So you just do the math, $675 to $850 in 3 years. I think this property will probably rent for over $1,000 within the next 3 years. That's just my opinion. Closing costs, that's kind of like year one. So some of these things are year one costs to kind of try to consider. So closing costs is in there, and then also maintenance. So what maintenance do we think are going to, and then we also put higher than our B-class neighborhoods. I think our B-class is 4 to 5% that we try to predict or try to assume in the Proforma when it comes to the maintenance. So we have 7%. And then for ours, again, we have a lot more data in here. I'm not going to get into year 1, year 2, year 3, year 4, year 5, but it gets really, really, really interesting. And you can really see how, like, year 1 is fine, year 2 is okay, year 3 is okay, year 4. But really, when you start getting into that year 7, year 8, year 9, year 10, that's when the fun really starts happening. If you're looking at the numbers and tracking this and kind of geeking out on the real numbers. And I mean, again, like, this has come back to me over and over and over again. The properties that I've held for the longest have always made me the most money.
Interesting. Really good information. I do think it's a couple things that he mentioned to touch on. First of all, you mentioned that you have your own Proforma. So this is what we would use. We use ours. So, like, even if I'm acquiring my own deal, I use our Proforma. I'm familiar with it.
You got it.
And so that's very common. We hear people saying, well, hey, I run my numbers at X, and that's great. So in the end, it is good for you to have your numbers. There's your expectations for the deal, and figure that out. Now, I've had some people who have expectations that are crazy, that are just pie in the sky type things, which again, you don't see in our Proforma. We do not give you the pie in the sky best case scenario and say, hey, you want to buy this house. These are more conservative numbers.
Right. We don't give best case scenario, but we also, I don't believe we give worst case scenario.
Correct.
So,
Correct.
This is what I believe. If you held on to this property for 10 years, this is what I think you can assume could happen or more than likely would happen.
And so he mentioned the appreciation. Vacancy and maintenance is where I see the most where people would differ with our numbers. We feel these are actually pretty conservative. Still, nationally, people would be right around 5%. That's pretty basic for a provider. We're at 7%, understanding our market and trying to be upfront with our investors. However, we have not seen significant issues with these in our turnovers when they do happen. So, and of course, as we grow a little bit older as a company, we'll have more data to supply. But that's just
and you should know what that is, because I know that there's people out there selling rent-ready houses. So they're not turnkey.
Right.
They're calling them rent-ready. Yeah. So on a rent-ready house, the maintenance is probably going to be higher.
Absolutely.
Because it doesn't really mean that there's much. Maybe nothing has to be done, but nothing really was done, and nothing was really checked out. So, and just because you have a home inspection doesn't even mean that something's still not going to go out in the next 2 or 3 years.
Sure.
I mean, I've seen roofs honestly go out in 5 or 6 years with brand new roofs put on properties, and that's not normal.
Right.
But for some reason, in some climates or some types of weather, it happens sometimes.
Sure. Yeah.
But for us, for instance, I mean, I'm not going to put a brand new roof on a property if I think it still has 7, 10, 15 years left on a roof. And you don't really know that. You just make assumptions. You go to the property, you look at them, and you say, hey, this checks off. A home inspector looked at it as well, and he says there's no leaks. It looks like it still has some life left on it. And to me, if I don't want to waste money on something that is going to get me 5 years or 10 years worth of life out of it, to me, it's a waste of money. Like, it's a waste of that use that you didn't get. So, and it's not new. So that's the other thing. I mean, these houses aren't new, but I've known new houses that have issues. So, yeah, I would be assuming some type of same, numbers even for brand new houses. At least a 3% maintenance on even brand new houses. And you have tenant damage that they don't want to admit half the time, but there is tenant damage as well.
Yeah.
And that's another whole issue for a different topic. But again, this is what we use. This is honestly how we vet our own deals when we're buying
Absolutely.
them. So we don't try to just use this for when we sell, but we also try to use this exact same performa. I want to know exactly what a property, I want to know what the assumptions that we're making when we're buying the property. And that's really what a performa is it's really the assumptions that you're making at the beginning when you buy a property. That is it.
So I think one thought that comes to mind when you are putting your own numbers in your own performa, make sure those are also conservative too. I mean, if you're trying to make those pie in the sky and say, oh, well, maybe it could be this, and if I do that, it'll be this, and then that's your performa, it's your best case performa, and then you're making a decision based off that. That's not the best way to go. So again, in this case, this house is marketed. We have this as estimated rent. So basically, the rehab's finishing up now, and we're gonna start marketing it. This says $850. Well, we're not singing out $850. We're actually marketing this one probably a minimum $895. And so what that means is, obviously, in this case, we've sent this out to our buyers list less than what we're actually marketing the property for rent, meaning there's an opportunity for more cash flow, but that's not what we're putting in here. So we're trying to provide that conservative side. And so you should do the same thing when you're doing your numbers and trying to do projections based, whatever that looks like, is never based off the pie in the sky. And also in negotiations, the lowest too.
Yeah, you can't do both. I mean, that's the thing. Like,
right.
You can't buy something only based off of worst case scenario either.
Right.
But you need to know what worst case scenario could be, and then you need to know if you're okay with that. Right. So you see best case scenario, you see worst case scenario, you see what I think is the middle ground, which is what the performa normally should be, and that is kind of like, what is a reasonable, what are the assumptions that we're going to make when it comes to this property. Or any deal, really. It's not just a property, but like any deal you do, any kind of business you get into or anything, know the risks, know worst case scenarios, know the benefits and the features and the things that could happen, and then know what's reasonable and what assumptions that you can make that you think are reasonable to happen, and then make your decision based off of that. And a performa is just one of those tools that you can use to help make those decisions.
Absolutely. I like to think of it as it's just a present day snapshot of what this deal could look like based off of today's information for the next however many years. And so I hope you guys really enjoyed this podcast. Hope you found it insightful. And so appreciate you guys joining us. Just remember, we do provide rental properties to investors. We actually build rental portfolios for investors. So if you are interested in purchasing from us, we'd be happy to work with you. You can reach me at jared@byolsongroup.com. And we appreciate you for joining us.
Yeah, or you can visit us at byolsongroup.com. It's BUYOLSON.com. So that's awesome. I appreciate Jared for being on here, and I appreciate you guys for watching. Hopefully we didn't bore you too much with these numbers.
Of course not.
And hopefully you didn't have to get too many cups of coffee during this podcast. So thank you so much for listening. If you could do us a favor, one thing that we are trying to do is we are trying to build this audience and try to build. If you could go on to Apple and give us a 5-star rating, that would really do a lot for us. So if you've enjoyed this, please tell your friends about us. Absolutely. And tell other people about the Active Turnkey podcast, the best way to buy rentals, right?
That's it. Thanks, guys. Olson Group Network makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Unless specifically stated otherwise, Olson Group Network does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. Any third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of Olson Group Network. Olson Group Network assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials or on third-party sites referenced in this podcast, or the compliance with the applicable laws of such materials and/or links referenced herein.